good people, welcome, and in today's video I'll be looking into a book which I read when I wanted to learn about the stock market. The book is The Intelligent Investor. It's a pretty old book. It was written in 1949, if I'm not mistaken. Yeah, it was written by Benjamin Graham. This is Warren Buffett's teacher. So if Warren Buffett is a billionaire, I think he's in the top 10 on the Forbes list of the richest people. He learned his investment philosophy or investment technique from this guy, Benjamin Graham. And he was still alive back then, but now he's passed away. So he also wrote some books, several books, I think. Yeah, he has The Intelligent Investor, and the other one is Security Analysis, if I'm not mistaken. Those are the most detailed books when it comes to the stock market and investing. It's a great book to read. The book is not for, let's see, amateur, I wouldn't say amateur investors, because it dives into the stock market and finance very deep. It could be a challenge for someone who's not a finance head, because there are terminology there which you will need to research to understand. But it wasn't the only problem I had with the book, or the only difficulty I had about reading the book. It's because it's a very thick book. It's a long book. It's twice the amount of pages I usually read. It's about 600 or 650 pages long. So it's really a thick book, but it has invaluable lessons in it. So yeah, that's the book, and there are several lessons which one can take away from the book. For instance, the book emphasizes or dives into the importance of margin of safety. Okay, Graham emphasizes investing with a margin of safety, which means most of the time purchasing securities at a significant discount to their intrinsic value. This helps protect against errors in judgment or unforeseen market downtrend. The first word is, what is intrinsic value? Those are the terms which the book uses. So if you're not familiar about those terms and you're not a finance head, you'll need to research what does it mean to buy a stock close to its intrinsic value. But to basically explain what intrinsic value means, it means the actual value of what the company is worth, not what the market perceives it to be worth. So to calculate the intrinsic value of a company, you'll need to do some research, look into fundamentals of the company, look at its dividends, its earnings, its products, growth, perspective, and all that stuff. So yeah, so it's an in-detail calculation. That's one of the things that the book goes into. The book also teaches you to distinguish between investing and speculating. Graham differentiates between investing and speculating and teaches you what's the difference between the two. So just to explain what's the difference between the two, most of the time when you speculate, you look at the short-term period of that security that you want to trade, basically. So you look at things like technical analysis, movement of the stock price, and you are only invested for maybe from an hour to maybe a week max. That is speculation. But when you are investing in the stock market, you're looking to hold your position or the stock for more than a year, and for the long term, basically, because you look at the fundamentals of the company shares that you want to buy. So that's the difference. That's basically the difference between speculating and investing. And as I've said, the book goes in details with regards to the concept of intrinsic value, and mostly you use earnings, dividend, and growth perspective rather than its market price to calculate what the actual value of the company that you want to buy. And the other thing is that the book goes in details about is Mr. Market. That's the overall market where every stock is traded, every company is traded that is listed. Benjamin Graham goes into explaining that you need to treat the market as a person. See it as a person who is sometimes over enthusiastic, someone who's sometimes in a good mood, or who's too happy at times, and then sometimes it's just sad, gloomy, and doesn't see the future as being bright and sad. So you need to determine when Mr. Market is overexcited about the future and when Mr. Market is sad about the future, and then you can use those mood swings to buy good companies at a good value or at a discount. And then the book also goes into details about the value of fundamental analysis. Conducting thorough fundamental analysis is really essential before you go in and just scoop shares of any company. You need to do your due diligence in finding out how the company is doing. And the only way you can do that is not by looking at the chart of the company, the price. You also have to do research, look at income statement, look at the balance sheet, look at the fundamentals, the products they are selling. Do they have a mold around in the industry? For instance, like if you want to buy shares in Coca-Cola, you'll need to look at their dividend history, their profits. Are they growing every year? And how much is their profit margin? How many assets do they have? How many debts does the company has? Those are the fundamentals of the company. And then if you are happy about those fundamentals, only then you can decide to buy or not to buy the stock. So the book is very detailed, and the book also goes into the benefits of using a defensive investment strategy. Graham advocates for a defensive or a passive investment approach for those who lack the time or expertise to actively manage investment. So when you do defensive investment, it's when you buy companies which have a long history, like McDonald's, Coca-Cola. They have long history of paying dividend, and they've been around for years, and they've created a mold around their industry. And he also, if you're not a professional stock picker, he also says you can just buy an index fund of the S&P 500, which has done like 9 to 10% for the past, century or decades. So you can just buy that and just average down, buy it every month or every year. That's the best way, because stock picking is basically not for everyone. So the book also goes into details about that. The book also teaches you about being disciplined and being patient. You can't just be over excited and get a FOMO of buying stocks just because everyone is buying. You need to wait for the right moment, the right setups to buy certain stocks. So it also teaches you about discipline and patience. It also goes into the importance of avoiding making emotional decisions. Just calm down. Do not get too excited or too scared and then start selling everything. You need to stick to your analysis. If your analysis says it's a good time to buy, it doesn't matter what the stock price does. So you carry on, you buy, you keep on buying the stock. It also teaches you the importance of diversification. You need to diversify your investment. You can't just buy tech stocks, because what happens if the tech industry start having problems and your portfolio start going down. So you need to diversify, buy different stocks in different industry, technology, food, energy, commodities. You need to know how to diversify your investments. Yeah, the book is really detailed. So if you want to learn about investing and how to pick your stocks and how to actually generally learn about the stock market, I think this is the book for you. It's going to take time to understand most of the terminology in the book if you are not a finance head, but it's a good book to read to learn about the stock market. If you're interested about the book, I'll leave a link in the description below. You can just click to it and get the book. And if you enjoy these videos, please do not forget to hit that like button, subscribe to the channel and turn on the notifications. Until our next video, peace. I'm out.